So once again, so here's our new examples, right? So our effective rate is now less. So what do I know about this? Well, I know now that this bond is going to issue at a premium. Well, how do I know that? Well, think about it. The company is committing to pay 9% to the bondholders, right? That's what the company is committing to do. However, the investors are sitting around with $1,000 in their pocket and they're saying, well, where should I invest my money? Now, they're looking around at similar investments with similar risk, and they're only able to earn 8%. So now everybody wants to buy my bonds, right? Everybody's clamoring to buy my bonds because I'm willing to pay 9%. So guess what I'm going to do now? I'm going to be smart, right? I'm going to charge a premium for these bonds. So that's kind of a simplistic view of it, but that kind of explains why this bond will issue at a premium. The pricing model will dictate the price, right? So let's just assume that we run this through the pricing model and it spits out a price of 104. Now again, don't try to calculate this. It's not going to work, right? You have to run through the pricing model, and I happen to know that this is not actually the right price, but it'll work for our illustration purposes. Now we know it's above 100. That's how we know it's a premium. Remember, 100 is par. So any price above 100 is going to be a premium, in this case 104. So we're going to do the same thing we always do. We're going to take this this price, and we're going to do the entry upon issuance of the bond. So let's say now again it's January 1st, we're ready to do the entry upon issuance. We go out to the marketplace to raise the money. So what we're going to do is we're going to take this $1,000, we're going to multiply it by the price of 104. In this case, we just move the decimal over 2 spots, so it'll be 1.04, right, or 104%. So what we're saying is, we went out to the market wanting to raise $1,000, but guess what? We were actually able to raise $1,040 in cash because we were able to charge a premium. So here's what we're going to do. We're going to take and put that as our debit to cash, just like we did before, right? Just like we did before. There's our debit to cash 1,040. So we actually raised more than we thought we were going to raise. But here's the kicker. At the end of the 5 years, guess what? As the company's only got to pay out $1,000, which is the principal amount of the loan. So that's all we've got to do. So what we're going to put is in the bonds payable account, we're going to put the $1,000 just like we did before, the original principal amount. Now, I can't leave my entry like this, right? Because what problem do I have? My debits don't equal my credits, do they? Right? This time, what do I need to balance it out? Just look. I've got a $1,000 debit. I'm sorry, $1,040 debit, and I got a $1,000 credit. I need another credit. That credit is going to be what we call a premium on bonds payable. So this time, remember, discounts were debits, right? So logically, if a premium is the opposite of a discount, it's going to be a credit, right? So I've got a 3-line journal entry here, right? 3-line journal entry, my entry upon issuance of the bond. Just like that, okay? So just like before, what's going to happen? Well, same thing as before. Nothing's going to happen in this bond for another 6 months, right? But at the end of June, we're going to have to do 2 things, just like we did before. The first thing I've got to do is pay interest on this bond. Well, guess what? What interest rate am I going to pay at here? Just like before, I'm always going to pay out the stated coupon rate. Remember, that was the rate that we committed to back in October. That was the rate that was locked in, right? We're saying we're paying it 9% annually. We're actually paying 2 times a year, right? So we're going to do the same calculation we did before. $1,000 times 9% times 6 over 12, or half it, right? So it's semi-annual. So that's $45, just like before. So I'm going to make my entry just like before. I'm going to credit cash, $45. I'm going to debit interest expense, $45, all right? So I've got those 2 entries, all right? Now, at the same time I make that entry, guess what I also have to do? I have to amortize my premium. Just like I amortize my discount, I need to amortize the premium. Using a straight line amortization method, same method as before here, same method as before. So I've got $40 here. How many total interest payments do I have? How many total interest payments? Well, again, I got a 5-year term, right? I've got 10 interest periods. So I'm going to take the $40, this time divided by, once again, 10 interest periods. These are just things you're going to have to remember. So my amortization here is going to be what? $4 per 6 months, right? Per interest period, $4. So think about what amortization means again. Amortization simply means what? It simply means that I'm going to what? I'm going to draw down that premium balance, right? I'm going to draw it down. So I've got a $40 credit. How would I draw down a credit balance? So in order to draw it down, I'd need to debit it, wouldn't I? So I'm going to go ahead and debit $4 to the premium account. Debit $4 to the premium account, okay? That's how I'm going to draw it down. Now with every debit, what do I need? I need a credit. That credit is going to go to interest expense. $4 to interest expense. Now, it's not often that we'll credit interest expense, right? Crediting interest expense effectively reduces it. So what is my effective interest rate now for this period? Well, it's not $45 like I paid, right? It's $45 less the 4. The amount that's going to show up on my income statement for this period is not $45. It's going to be what? $41, right? In total. All right, well, why is that? Well, it's the same argument in reverse. I mean, go back to the start of this bond, back on January 1st when I issued this bond. I wanted to raise $1,000, but because I was able to charge a premium, we actually raised $1,040 more. But at the end of 5 years, we only have to pay back $1,000. We get to keep that $40, right? We get to keep that $40, and we can kind of think of it this way, we can kind of use that additional $40 as a credit against any interest that we pay. Because remember, we're paying at 9%. We're paying at 9%. So another way to think about this is that, again, if you go to the end of the bond and you kind of ask yourself, okay, if I made this entry every 6 months, right? Made these 2 entries every 6 months at the same time, what's going to happen at the end? Well, at the end, my premium's going to be 0, right? My premium's going to be 0. And all of that premium is going to be as a credit to interest expense, effectively reducing the interest expense. So what rate at the end, if I just kind of looked and said, what happened in the end, what rate did I really pay at? Well, did I pay at 9% or did I pay at 8%? You paid at 8% because you got to keep that $40 as kind of like a credit over those 5-year period against that total. So that's really what the effective interest rate really does here, right? So that's why we credit interest expense there. Now, you'll see this oftentimes in the book when you guys are doing the problems. So take these entries and combine them. So because that $45 and the $4 amortization happens at the same time, they'll combine those, or they'll smash them into one journal entry. I think you'll be able to follow that, no problem. But the idea is they happen at the same time. So just be aware of that. I always like to separate them here because I think it's just a little easier to illustrate. But just be aware of that. Also, just kind of another note on carry value. You're going to see this term carrying amount or carrying value being talked about. And when you're talking about a premium to calculate the carrying amount in a bond, again, you're going to take the bond's payable total, which in this case is $1,000. And in this case, you're going to add the premium balance because it's also a credit, right? So in this case, after you make the amortization entry, your carry value would be what? In this case, $1036 would be your carry amount at this point, right? After you amortize that first amount. Your carry value over time, as you start to amortize your premium, will eventually start to go down, right? It's going to work its way back down to 1,000, just like it was the opposite when we had a discount. It worked its way back to 1,000. So make sure you understand this concept of carrying amount as you kind of move forward in the course. It's going to become more and more important, right? As in this particular lesson. Make sure you understand how that works. All right. Okay, so those are 3 examples. We had issuance of bond at a par. We have issuance at a discount, issuance at a premium. Make sure you understand how these work. They all work the same way. You just kind of progress through them. Whatever you do, don't get in the habit of just kind of just throwing numbers around when you're doing these entries. You've got to work through these entries very mechanically, very methodically. All right. Hope that helps.